Professor Jim Schultz here from my Finance 512 class. I wanted to go ahead, I know it's near the end of the project, but more so than for the last couple days if you're trading, I wanted to do one final video here in the Thinkorswim software going through a couple of more advanced option strategies to give you guys a little bit more experience and exposure to the options market and some cool things you can do so that hopefully when this class is over, you continue to trade on your paper money accounts and become more experienced, more seasoned, and more educated traders. And so the first strategy I'm going to go through, I was looking at Netflix. I'm not going to do Netflix. But the first strategy I want to go through is how to set up what is called a call spread. This also is called a vertical spread. It goes by a couple different names, and so let's go ahead and do Apple, just because that is a company that you guys are kind of familiar with. This can be called a call spread. Specifically, it's called a bull call spread. I've also heard it referred to as a vertical spread, and in the Thinkorswim software, it's called a vertical spread. But we're gonna do it a different way. So let's say that you're looking at some May 2013 options, right? We don't want to do April because they expire in 2 days. You could if you want to, but so I'm going to open up this May 13 option window, and I'm looking at 4 different strikes. I'm going to change this. I'm going to look at like 6 different strikes. All right. So here's the basic idea behind a call spread. Suppose that you were looking at this May 13 option with a 420 strike, and you wanted to buy a call, right? So you can see this is the price you would pay, 1560, 1565. Obviously the market's just opened, and so that's going to change as I speak. But let's say you wanted to buy this call, right? And the current price of Apple's 415, so that's all time value because this guy's out of the money, right? Maybe you don't want to pay 1560 because that's kind of steep, right? You got to multiply that by 100. That's a per share number. So here's what you could do to reduce the cost of getting into a bullish position in options in Apple. It's obviously going to reduce the potential gain as well, but it's going to reduce the cost. What you could do is set up a call spread where you buy this May 13 420 strike, but at the exact same time you sell like a May 13 430 strike. Okay, so you are actually long one call and short another call. Right? And so it may look like they cancel out and you're not going to make any money, but the way it works is you're long at 420, short at 430, right? And so let's go ahead and set this guy up. So I'm going to click buy, so I get into this menu, right? Now I'm only going to do one because I don't want to go crazy. But now here's what I'm going to do. I'm going to right click and just create duplicate order. Oh, actually, hang on a second. Yeah, we gotta let's cancel this. We gotta do this a different way. I haven't done this a little while in Thinkorswim, and so here's what we've got to do. We're targeting this 420 430 strike. Okay, we're gonna pay 1560 for the 420. We're gonna receive 1160 for the 430. All right. What you have to do is where it says spread up here, you've got to change this from single to vertical, right? Which is kind of what I was talking about earlier, where call spreads can be called vertical spreads or call spreads. So this is vertical. Now what it's going to change where it says 400, 405, 405, 410. This is the call that you're going to buy. This is the call that you're going to sell. And it's basically saying that if you did a 420, 425 call spread, it's going to cost you 225 total. Because remember, you're paying one and receiving the other. But I want to do a 420, 430 call spread. So what I'm going to do is I'm going to click on this one. But what I'm going to do is I'm going to change, see how it already populates, buy and sell? I'm going to change this from 425 to 430. Because that's what I want to do, right? Right now, this is going to cost me, well, I'm going to make it a market order, but this should cost me about 388 or 390. All right, now I'm going to obviously change that to 1. So the way this works, the difference between the two calls is 10 bucks. So the most money you can make on this is the difference between the two calls less whatever you pay for it. All right, so let's say if this were 390, the most money you can make is 10 minus 390, or $6.10. And you'll make that if the stock price rises to the strike price of the call that you sold before expiration or at expiration. So if I make this a market order and I ship this guy off, so my vertical spread just got filled. If I go to monitor, you can see Apple. I am long at 420. I am short at 430. I am right now down $2.50. But my goal here is for the strike price to rise to 430 before the third Friday in May. So this is a way for me to, I only paid $3.90 approximately for this option. Now, it was a market order, so I couldn't control, exactly what I paid for it, right? You could control that if you did a limit order. But this is a way for me to get bullish on Apple using options without having to pay, if we go back to the single here, without having to pay $15 to get into a 420 strike. I sold off any gains over 430, but I reduced my costs significantly from $15. So that is how you do a call spread in Thinkorswim. So now let's talk about how to do a straddle in Thinkorswim. So let's use a different stock here. Let's do Google, just to do something a little different. So here's the way a straddle works. Let's look at like June, just to again do something different. Let's say that Google has a huge earnings announcement, or maybe a product announcement coming up in June, and you think that that announcement is going to be a really strong catalyst for either a big move up or down in the stock. You don't know which way it's going to go, but you think it's going to be a huge move one way or another, and you want to profit from that volatility. Well, what you could do is you could set up a long straddle in Google. And what that is you're actually buying a call and a put at the same strike price. And so if you actually think about that, the way you're going to make money is you need a huge move either up or down from that strike price to make money, right? So let's say that the current price of Google is $7.87. Let's say you're looking at basically your at the money calls, so about $7.85, right? So right now, the calls are going for about 31.5. The puts are going for about 29, just over 29, right? So let's say I'm focusing on this 785 call. So what I'm going to do is I'm going to again click on the spread and I'm going to select straddle. If you want a 785 straddle, right? These are the same because this is your call, this is your put. If you want a 785 straddle, it's going to run you 60-60 because you got to pay for the call and you got to pay for the put. Right? So basically, you need a huge move out of Google to make some money, because you're going to have two break-even points, right? You're going to have a break-even point that's $60.60 above the strike price, and $60.60 below the strike price. And so you're banking on an enormous move, but if Google soars or collapses, you can make a lot of money. And so what I'm going to do is I'm going to click on this guy, and then you see I'm buying one call and I'm buying one put, both at 785 strike. And I'm going to make this a market order just so it goes off immediately and you guys can kind of see that. So let's ship this guy off. All right, so I filled right away. I go back to my monitor tab. So I still have this call spread going on Apple, and it's not going too well so far. But in Google, I have purchased a call and a put at 785. Now, the pricing of these as they move before expiration is kind of sticky, and we would need to go through this in class to really talk about this. This is pretty advanced stuff. But I did want to show you guys at least the basics behind how a call spread and a straddle work. A long straddle. You could do a short straddle as well. But the basic idea is that a long straddle is going to profit from extreme volatility. So hopefully these videos were helpful at least in giving you a basic understanding of two of the more popular advanced option strategies, call spreads and straddles.